Welcome students, welcome to lecture number 29 where we'll be continuing with module number 4 under subject direct taxation. So under this module, as we know, we have different types of things to be covered which we have already covered. We are just left with income from other sources, theory only. It doesn't come under income under head capital gains. But in your as per VTU syllabus, this particular head of income is covered in this particular module. And deductions from capital gains we have already seen, but we have not covered problems where deductions are involved. So today what we will be doing is we will be seeing problems on computation of capital gain considering deductions, which we have seen in our last previous lecture, different types of deductions from section 54 to 54B, 54F, 54EE, 54E. So considering those deductions, we will be seeing certain problems on that. And income from other sources, you have only theory students and nothing else. So let us see. As you all know that this is a format for computation of short-term capital gain, like sales consideration, less expenses on transfer, you get net sale consideration, less cost of acquisition, cost of improvement, you get short-term capital gain. And from the short-term capital gain, when you minus the deductions, or you can also say as exemptions, you will get taxable short-term capital gain on which the tax is to be charged. Next, you have a computation of long-term capital gain, where you will be seeing this is a format for computation of long-term capital gain. That is, everything remains the same, but for long-term capital gain, you're going to take index cost of acquisition and index cost of improvement. And then you again exemptions, that is deductions, you have to minus from long-term capital gain in order to get taxable long-term capital gain. So before solving any problem, if you all keep the format in your mind, it will be very easy for you all to solve the problems. Now, quickly, we'll just see summary of the deductions and then we'll proceed with the problems on deductions, considering deductions. So we know section 54, 54B, 54D, section 54EC, 54EE and 54F are certain types of deductions that are given when you compute capital gains. So quickly we will see section 54. It is available only to individual and HUF, where the asset should be transferred should be a residential house, and this house should be chargeable under the head of income from house property. Section 54B, it is agricultural land, you are investing in an agricultural land. Section 54D is a building which is forming part of an industrial undertaking and you are investing it another the capital gains in the purchase of a land or building that is forming part of an industrial undertaking. 54EC, where you're transferring a land or building or both and you're investing in the National Highway Authority bonds in a National Highway Authority corporation or rural electrification corporation, where you're investing your gains in bonds which are redeemable up to a period of 5 years. 54EE is again you're transferring any long-term capital gain and you're investing in the specified bonds. 54F is where long-term capital asset, if you're transferring other than a residential house, but you are investing it in a residential house. Next, we know what is the amount of exemption. You will get the cost of the new asset what you're purchasing or the capital gain, whichever is lower in all these sections, exception 54F, because in 54F, the amount of exemption that will be given is the cost of new residential house. You have to compare it with the net consideration. Okay, and if the cost of new residential house is more than the net sale consideration, the entire capital gain is exempt. And if the cost of residential house is less than the net sale consideration, then only proportionate capital gain is exempt. And you all know in what it has to be invested and what is the period of investment. The last important thing that we need to consider is whatever exemption you're getting based on what that your capital gains you're investing in some other asset. But if that new asset in what you're investing in under section 54, if you're selling that new asset within a period of 3 years, whatever capital gain you had earned, or whatever capital gain you had taken the benefit of exemption, that will be reversed. What it means is, under section 54, you know that when you sell a residential house and whatever capital gains you're getting, you will invest it in another residential house. That new residential house should not be sold for a certain period of time. Suppose if that new residential house is sold within a period of 3 years, whatever deduction you had got, that will be reversed and it will be reduced from the cost of acquisition of new asset. So it is revocation of benefit. Whatever benefit of deduction you had got, it will be revoked, it will be reversed, and it will be added to the cost of acquisition only if you transfer the new residential house within a period of 3 years. Similarly, under section 54B, if you are transferring the newly acquired agricultural land within a period of 3 years, then again the benefit of deduction will be reversed and it will be added to the cost of acquisition of the new asset. Similarly, under section 54D, within 3 years if you are transferring, such revocation will be reduced from the cost of acquisition. Under EC, there is a period of 5 years. Within 5 years, you cannot redeem the bonds, because in EC, section 54 EC, you are investing in bonds and that cannot be redeemed within a period of 5 years. If it is redeemed within a period of 5 years, then the benefit of deduction will be reversed and it will be treated as a long-term capital gain. Similarly, under section 54 EE, if you are transferring the bond within a period of 3 years, then such transfer within a period of 3 years shall be treated as a long-term capital gain. Even under section 54F, within a period of 3 years, the new residential house should not be transferred. And if it is transferred, the benefit of deduction will be reversed and it shall be treated as a long-term capital gain in the year of revocation of the condition. So remember, under section 54, 54B, 54D, if it is transferred, if the new asset is transferred within a period of 3 years, it should be added back to the cost of capital in the year of transfer. And under section 54 EC, 54 EE, 54 EF, if it is revoked within a period of 5 years, 3 years and 3 years respectively, then such revocation of income will be treated as a long-term capital gain in the year of transfer. So this is revocation of benefit. Next, let us see problems considering deductions under computation of capital gains. Okay, students, let us start. Mr. Siddhartha has a residential house property which is taxable under section 22. Means it is taxable under the head house property. Such property is acquired in the year 2005 for 2 lakh rupees. The property is sold on 1/3/2019 for 25 lakh. Now, if it is sold on 1/3/2019, which financial year it is falling in? It is falling in the financial year 2018-19, means it will be taxable in the assessment year 1920. Next, after selling this property, what he did, he acquired another residential house on 31/3/2019 for 17 lakhs for self-occupation. On 1/3/2020, he sold such new residential house for 30 lakhs. Compute his capital gain for the assessment year 1920 and 2020-2021. Now here we can see that he is having a residential house property which he is and whatever capital gains he'll be getting from that residential house property, he is investing in another residential property. So here he can get exemption under section 54, because under section 54 we know that sale of one residential property, the gain of which is invested in another residential property within a period of 2 years, or 2 years after the date of transfer, or construction within a period of 3 years after the date of transfer, you can get deduction under section 54. So let us see. Computation of capital gain of Mr. Siddhartha for the assessment year 1920. So what is the sale consideration? He has sold the property for 25 lakhs. So sale consideration is 25 lakhs. Less, there is no expenditure on transfer. So net sale consideration is 25 lakhs. Less index cost of acquisition. How do we calculate index cost of acquisition? Cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. So what is the cost of acquisition? Such property is acquired in 2005 for 2 lakh rupees. He's transferring in the year 19. So 1920, if you see the cost inflation index, it is 280 divided by CII of the year of acquisition. He has acquired it in 2005. So the cost inflation index of 2005-6, if you see, check the table, it is 117. So the index cost of acquisition comes to 4,78,632. Less index cost of improvement. There is no cost of improvement. It is going to be nil. You got long-term capital gain by minusing 25 lakhs with 7,78,632, which you got as 20,21,368. Okay. Up to here, you'll know how to solve it. Next, you have to see whether he is eligible for exemption or deduction. Yes, he is eligible for exemption because under section 54, we have seen that when this capital gain is invested, he acquired another residential house on 31/3/2019. So we know that sale of one residential house, if it is invested in another residential house within a period of 2 years if he's purchasing or 3 years if he's constructing. Now see, he sold on 1/3/2019 and is purchasing on 31/3/2019. So it is well before 2 years from the date of sale. So he's going to get an exemption for the amount he's investing. So the exemption amount is 17 lakhs. So he's getting a deduction under section 15(4). And what is the amount of exemption, students, we have seen? That is, exemption will be the long-term capital gain or the cost of the new house that is acquired, whichever is lower. So which is lower? The long-term capital gain of 20,21,368 or 17 lakh. 17 lakh is lower. Therefore, the exemption will be the lower of the two. So minus 17 lakh, you got taxable long-term capital gain as 3,21,368. Now, the condition under section 54 also says that if the house is purchased, new house is purchased, it should not be sold within a period of 3 years. And if it is sold within a period of 3 years, then what will happen, students? That benefit will be reversed and added to the cost of acquisition. So let us see ahead. On 1/3/2020, he sold such new house, residential house, for 30 lakhs. Actually, he should not be selling it for a period of 3 years. Now, before 3 years completing only, he is selling it. So let us see what is the computation of capital gain of Mr. Siddhartha for assessment year 2020-2021. Sale consideration, he's selling the new house for how much? 30 lakhs. So since he's selling before 3 years, this benefit what he had got of 17 lakh, it will be added to the cost of acquisition. So what happens? Less expenditure on transfer. So net sale consideration is 30 lakhs. So it will be reduced from the cost of acquisition. Sorry, students. So less cost of acquisition. So this new house which is selling for 30 lakhs, he had acquired this new house for 17 lakhs. So cost of acquisition is actually 17 lakhs. But the benefit that he had taken earlier of 17 lakh will be reversed and reduced from the cost of acquisition. Therefore, you're reducing 17 lakhs exemption what you had taken earlier in the earlier assessment year, and the cost of acquisition will be nil. So short-term capital gain will be 30 lakh. Now, why we have reversed this exemption? Reverse means you're going to minus this exemption. Why? Because the new house should not be sold for a period of 3 years. And since it is sold for a period of before the period of 3 years, you have to reduce that benefit. Here you have taken benefit of 17 lakhs. You have to reduce it from your cost of acquisition. Therefore, we have deducted 17 lakhs and the short-term capital gain is 30 lakhs. So students, have you all understood this deduction under section 54? Remember, deduction under section 54 will come into picture only when you are selling a residential house and you're investing in a new residential house, and that new residential house should be purchased either 1 year before the date of transfer or 2 years after the date of transfer, or if you're constructing, it should be constructed within a period of 3 years from the date of transfer. And you will revoke it if that new house you're selling before period of 3 years. So students, is this problem clear? Or any doubts in this problem? Yes, students? Students?
Ma'am?
Yes, ma'am, understood.
Okay. Next, moving ahead to section deduction under section 54D. Okay. Now let us see. Mr. X has a building acquired on 17/8/2018 for 5 lakh rupees. The SSC as a tenant earlier used the building for industrial purpose. So if it is industrial purpose and is investing in another industrial thing, then you should remember it is covered under section 54D. So industrial purpose is using for last 7 years, and even after purchase, it is continuously used for industrial purpose only. Such building is compulsorily acquired by government at an agreed value of 12 lakhs as on 15/7/2019. The compensation was received on 1/3/2020. So if we know under compulsory acquisition by government, what is going to be the sale consideration? Sale consideration will be the compensation received by the government. The written down value of the block of assets as on 1/4/2019 is 7,50,000. So that means these are depreciable assets, and in depreciable assets, we know that we have to take the written down value as the cost of acquisition. The company acquired the new building. Now, this building he sold. This building he transferred. It was compulsory acquired by the government, and he invested that in another new building for residential, for industrial purpose. So remember students, industrial purpose, if he's using a building and investing it in an industrial purpose, then it will be covered under deduction 54D for 2 lakh rupees as on case 1, 31/3/2020, case B, if he's acquiring the new building on 2/4/2020. Determine the taxable capital gain. So let us see. Mr. X purchased the building on 17/8/2018 and transfer took place on 15/7/2019. After acquisition of ownership, asset is used for industrial purpose for less than 2 years. However, the SSC was using the same building for industrial purpose as a tenant before acquisition for a period of 7 years. Hence, he can claim the benefit. What is the condition? That he should be using it for the industrial purpose before transfer, which he is using even as a tenant, even as a owner, still he is using it. So let us see. Computation of capital gains in the hands of X Limited for the assessment year 2020-2021. So first, usually we always take sales consideration less cost of acquisition. But here we need to calculate cost of acquisition because it is a depreciable asset, correct? So what is the written down value of the asset as on 1/4/2019? The written down value of the asset as on 1/4/2019 is 7,50,000. So case A, we have written 7,50,000, case B 7,50,000. And how do we calculate the WDV of a particular asset? We take the opening balance, then we add purchases made during the year. So add acquisition of asset during the year. So during the year, the company acquired the new building for industrial purpose for 2 lakh rupees. So here we have taken 2 lakh, but why in case B we have not taken 2 lakh? Because it is acquired in case B in the year 2/4/2020. So it will be taxable in which year, which assessment year? 2021, 2022. Therefore, we have not taken in case B. So what is the cost of acquisition? Now it is 9,50,000 and 7. So from sale, and what is going to be the sale consideration? Compensation received from government. So what is the compensation received from the government? It is 12 lakhs. So we have taken 12 lakhs in both the cases. So short-term capital gain is 2,50,000 in case A and case B 4,50,000. This you can show in another format. First you can show sale consideration of 12 lakhs less cost of acquisition 9,50,000, 7,50,000. Then you can show short-term capital gain. Now less exemption under section 54D. What is the exemption deduction they are going to get? Amount that you're investing in the new residential house or short-term capital gain, whichever is lower. Now what is short-term capital gain? 2,50,000. And the amount that you're investing in a new residential houses, new building for industrial purposes, 2 lakh rupees. So which is lower, 2 lakh or 2,50,000? 2 lakh is lower. So deduction you will get lower of 2. Capital gain or the cost of the new building used for residential purpose, whichever is lower. So 2 lakh and here 2 lakh. So what is the taxable short-term capital gain on which tax is to be levied? It is 50,000 and 2,50,000. So students, is this sum clear? Did everyone understand section 54D? Remember this deduction. This deduction you will get. Yeah.
Ma'am, only in case of residential building we have to take a return on value.
I cannot hear. What did you tell?
Ma'am, only in case of residential building only we have to take return on value.
No. In case of depreciable assets, see here they have given the written down value of the block of building. Now this is a building which is consisting of 3 buildings. Okay, and they have given here specifically that the written down value of the block as on 1/4/2019 is 7,50,000. Plus they are purchasing a new building. So building will form and come under the category of the same block, right? And this is a depreciable asset since they have given the WDV of that asset. If suppose the written down value was not given, then you would have directly taken the cost of acquisition as 5 lakh rupees. Is this clear?
Yes.
Okay. Is this problem clear, everyone? Yes, students?
Yes, ma'am.
Yeah. Now let us see a problem with deduction under section 54F. Now section 54F, what they say that when you are selling a asset which is not, when you're transferring asset which is not a residential house, but whatever gain you're getting, you're investing it in a residential house, then which section you have to claim deduction under section 54F. Now let us quickly read the problem. Sonu has jewelry acquired on 7/7/2010 for 5 lakh rupees. Okay, this is cost of acquisition, 5 lakh. On 18/8/2013, Sonu incurred improvement expenditure on such jewelry by adding diamond to it, worth rupees 3 lakhs. So this becomes cost of improvement. On 18/8/2017, he transferred such jewelry to his friend Monu for 40 lakhs. So 40 lakhs becomes your sale consideration. But for which assessment year, students? Now he's selling the jewelry in the year 2017, means it is coming under the financial year 17/18, means it will be taxable in the assessment year 18/19. Okay, now till here we know how to solve it. So first let us solve so much part. Solution: computation of capital gain of Sonu for the assessment year 18/19. Why assessment year 18/19? Because it is transferred in the year 2017. So obviously it will be taxable in the year 18/19. So sale consideration of jewelry 40 lakhs, less expenditure on transfer. There is no expenditure on transfer, so nil. Net sale consideration is 40 lakhs less indexed cost of acquisition less index cost of improvement. Why indexed? Because it is a long-term capital asset. 2010 he had purchased and 2017 he is selling. So it is more than a period of 36 months. So it is a long-term capital asset. How do you calculate index cost of acquisition? Cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. Similarly, cost of improvement is cost of improvement into CII of the year of transfer divided by CII of the year of improvement. So once you solve this, you will get 8,14,371 and 3,70,909, which amounts to 11,85,280. So from 40 lakhs, when you minus 11,85,280, you will get 28,14,720. Up to here, we know how to solve it. Now let us see whether he is eligible for deduction or no. Now he is selling a jewelry, but such jewelry, let us see whether he is investing in a residential house property to get exemption under section 54F. Sonu already has a self-occupied house property in Lucknow. However, on 17/3/2018, he purchased another residential property for 30 lakhs for the purpose of letting out. So yes, he is invested in another house property for the value of 30 lakhs. As on 5/4/2019, his friend offered him a house of 25 lakhs. Okay, for 25 lakhs, value of stamp duty purpose is only 14 lakhs for 15 lakhs only, and Sonu purchased the same. Now this comes in which assessment year, students? 5/4/2019. Now this will come in the assessment year 1920. So first let us finish the computation of assessment year 1819. So here we know that he has invested the capital gain in a residential house which is worth rupees 30 lakhs. So what is the exemption amount that you're going to get under section 54F? Under section 54F, the exemption will be the proportionate amount of capital gain. How do you calculate the proportionate amount? You compare the cost of the new asset with the sale consideration. So the cost of the new asset divided by the sale consideration into the long-term capital gain. So proportionately, you will get what is the deduction you're required to get under section 54F. Since the cost of the new asset is less than the sale consideration, therefore you are going to give it proportionately. So 30 lakhs divided by 40 lakhs into 28 lakhs 14,720. So the exemption is 21 lakhs. Here 1819 is 7,03,680. So we have completed the calculation for the assessment year 1819. Now let us see the assessment computation of capital gain for the assessment year 1920. Why 1920? Because we know that in the year 5/4/2019, what has happened? His friend has offered him a house worth rupees 25 lakhs, which is worth rupees 25 lakhs, but he's getting it only for 15 lakhs and the stamp duty value is 14 lakhs. And Sonu purchased also the same. And on 7/4/2020, Sonu sold the new house acquired from his friend for 19 lakhs. Value determined by the stamp duty is 22 lakhs and the market value as on the date of transfer is 26 lakh. So let us see. Since the SSC that Sonu acquired another house property, therefore the earlier exemption availed under section 54F shall be revoked and shall be liable to long-term capital gain. Hence taxable long-term capital gain is the exemption he is getting. See students, we know that the new residential house should not be sold for a period of 3 years, or he should not purchase a new house within a period of 3 years. If he is purchasing or selling it, whatever benefit he is getting earlier, that will be revoked and it will be chargeable to tax as long-term capital gain, which we have already seen here Here, section 54F, which we have seen, when you have to revoke the benefit, if the newly acquired house is transferred within a period of 3 years, or if another residential house is purchased within a period of 2 years or constructed within a period of 3 years, then such deduction what he had got earlier shall be taxable as long-term capital gain in the year of revocation of condition. Therefore, what is happening is, since he purchased a new house again, whatever exemption he had got earlier, that will be taxable as a long-term capital gain in the year where the revocation is taking place. Next, computation of capital gain of Sonu for the assessment year 2020-2021. Now, what is happening here? He is selling the property. See, Sonu on 7/4/2020, Sonu sold the new house. He's selling for a lesser amount when compared to the stamp duty value, then value should be taken as per the stamp duty valuation. Sales consideration should be taken as per the stamp duty valuation. Therefore, sales consideration will be value determined for stamp duty purpose 22 lakhs. Less expenditure on transfer is nil. Net sale consideration is 22 lakhs. Cost of acquisition. For what cost did he had acquired this? We know that he had acquired for 15 lakhs. So less cost of acquisition, we have taken 15 lakhs. There is no cost of improvement. Short-term capital gain is 7 lakhs. That is 22 lakhs minus 15 lakhs. So did everyone understand this problem? Section 54F. Students, in your exam, mainly you will be asked to calculate the short-term or long-term capital gains under section 54F for only one particular assessment year. But I have given you all a problem where you all have to solve for different assessment years so that it becomes easy for you all to, if it comes to be solved for one particular assessment year. So did everyone understood this problem? Yes, students? Just remember when, under what conditions the deduction will be given and when the deduction will be revoked. It will be revoked if the conditions are not fulfilled. Next again a problem on deduction under section 54F. What does deduction under section 54F says us? It says that if you are transferring any asset which is not a residential house, but you're investing in a residential house, you will get the deduction. And what is the amount of deduction you will get? You will compare the cost of the new residential house with the sale consideration. If it is less, you will give it proportionate deduction. If it is more, you will give the entire deduction. So let us see this. Mr. X has sold the following assets during the year 2019-20. Land it has sold for 10 lakhs. Jewelry it has sold for 30 lakhs. Sorry, cost of acquisition of land is 10 lakhs and cost of acquisition of jewelry is 30 lakhs. Sale consideration for land is 150 lakhs. Sale consideration for jewelry is 120 lakhs. Year of acquisition is given 1998, 1999. And jewelry it is given 2008, 2009. On 31/3/2020, he purchased a residential house for 30 lakhs for self-occupation and he has no other house till date. Compute capital gain. So we know that he's selling land and jewelry and is investing that amount in a new residential house. Okay, so we know he's eligible for deduction under section 54. So let us start solving. Computation of capital gains in the hands of Mr. X for the assessment year 1920. What is the sale consideration for land? 150 lakhs. For jewelry, 120 lakhs. Less expenses on transfer. There are no expenses on transfer. Therefore, net sale consideration is 150 lakhs and 120 lakhs for jewelry. Less indexed cost of acquisition, which is nothing but cost of acquisition into CII of the year of transfer divided by the year of acquisition. Now, cost of acquisition for the land is 10 lakhs, but it is acquired before 2001. And we know that if any asset is acquired before 2001, we have to take cost of acquisition or fair market value as on 2001, whichever is higher. Now, since here nothing about fair market value, nothing is given, therefore we are taking entire 10 lakhs as it is. 10 lakhs into CII of the year of transfer. It is transferred in the year 1920. So therefore the CII of the year 1920 is 289 divided by 100. Why did we take 100? Because indexation starts with the year 2001 and the base is 100. Therefore we are taking 100. Index cost of acquisition for jewelry, it will be 30 lakhs. Cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. That is, if you see the cost inflation index for the year 2008-9, it is 137. So accordingly, you have got this amount. Less index cost of improvement. There is no index cost of improvement. Therefore, it is nil. So long-term capital gain, when you minus net sale consideration from index cost of acquisition, you will get this amounts, that is 1,21,10,000 and 56,71,532. Now, we know that they are eligible for exemption under section 54F. Now, there is working for that. Let us see. In the given case, SSE can claim benefit under section 54F for any long-term capital gain. See section 54F. Now, there are two assets that he is transferring, land or building. And 54F is available only for short long-term capital gain. So it is the option of the SSE that he can opt for any of the deduction, either for the transfer of land or either for the transfer of jewelry. It is his option. So obviously he will go with that option where he is getting maximum deduction. So how are we going to calculate that? A comparative study is made under to decide from which long-term capital gain such deduction can be claimed. See, remember students, he cannot claim deduction under both the transfers. He has to decide, and decision will be based on maximum benefit in which he is getting. He will take the deduction under that particular part. So under section 54F, how do we see usually? We compare the long-term capital gain with the net sale consideration. So the cost of the new asset that is purchased is 30 lakhs, correct? And the net sale consideration is 150 lakhs and 120 lakhs. So obviously the cost of acquisition is less. The cost of new residential house is less than the net sale consideration. Therefore, we have to give it proportionately. How do we give it proportionately? 30 lakhs, either you can do 30 lakhs divided by 150 lakhs into the long-term capital gain. So we know that the long-term capital gain is how much in case of land and jewelry? We know it is 1,21,10,000 and for jewelry it is 56,71,533. Net sale consideration, land, in case of land it is 150 lakhs, in case of jewelry it is 120 lakhs. So how much benefit will he get under section 54F? This is the formula. A divided by B into 30 lakhs. So you will get 24,22,000 and for jewelry 14,17,883. Now among these two, under which he is getting maximum benefit? He is getting maximum deduction and for land. Therefore, he will opt for deduction under higher in case of land. Hence, the deduction under section 54F is 22,000. It should be 22,000. So less deduction under section 54F, that is 24,22,000. For jewelry, he will not claim because under section 54F, only for one particular transfer you can claim, and it is in the option of the SSE. Wherever he is getting maximum benefit, he will claim in that particular transfer. So for jewelry, he is not going to claim. So the long-term capital gain is 1,21,10,000 minus 24,22,000, which is 96,88,000. And when you minus this, you will get the same amount because the exemption under jewelry is nil. So students, have you all understood section 54F? Yes, students?
Hello, ma'am.
Yes.
Ma'am, that net sale consideration, less index cost of acquisition 10 lakh, how it came, ma'am, 10 lakh?
See here, this you're asking, right?
Yes, ma'am.
See here, in the question it is given For land, the cost of acquisition is 10 lakhs. And the
Yes,
year
ma'am.
of
You told that up to the 2000 year of acquisition is in 1998 and
correct,
1919.
correct. So listen, if the acquisition is before 2001, the cost of acquisition will be the actual cost of acquisition or fair market value as on 2001, whichever is higher. Now, here it is 10 lakhs. But in the problem, they have not given fair market value. So we consider fair market value as 0. As on 2001, no information is given. So 10 lakhs or 0, whichever is higher.
10 lakh, ma'am.
So we have taken 10 lakhs. If suppose your information was given that the fair market value as on 2001 is 12 lakhs, then you would take your 12 lakhs. But since information is not given only, what will you take cost of acquisition? Either the actual cost of acquisition or fair market value, whichever is higher. Now fair market value is not given. Therefore, you will take actual cost of acquisition only as cost of acquisition. Is this clear?
Yes, ma'am. Thank you, ma'am.
That is the reason you have taken the cost of acquisition as 100. CII for the cost of acquisition as 100 because it starts from 2001. Correct?
Yes, ma'am.
Okay. Did everyone understand? Deduction under section 54F? Yes, students?
Yes, ma'am.
When will you get this deduction? When you're transferring any long-term asset which is not a residential house, but you're investing in a new residential house. Next. During the previous year 1819, J exchanges his agricultural land being acquired on 1/4/2002 for 40,000. He had acquired this. So this becomes cost of acquisition against the agricultural land of Vijay for 90,000, which Vijay had acquired for 90,000. So for J, the cost of acquisition is 40,000 and for Vijay, the cost of acquisition is 90,000. Fair market value of such properties as on the date of transfer is 3 lakhs. Okay. Compute the capital gain of both, assuming the land is situated in urban area. So students, J is selling his agricultural land, exchanging his agricultural land for agricultural land. So he will get deduction under which section? 54B. Section 54 says that residential house invested in residential house. Section 54B says that agricultural land invested in another agricultural land. So he will get a deduction under section 54B. So let us see computation of capital gain for assessment year 1920. J, Vijay, they are telling to compute for both. So sale consideration for both is 3 lakh rupees because fair market value of such properties on the date of transfer is 3 lakh because since they have not given the exact value for which it is sold. So we are taking it as 3 lakh, 3 lakh. Less expenses on transfer. There is no expenses on transfer. Net sale consideration becomes 3 lakh. Index cost of acquisition for J is how much? Cost of acquisition for J is 40,000 and cost of acquisition for Vijay is 90,000. Clear? Now, why we have not taken indexed cost of acquisition for Vijay? Because Vijay had acquired it in 2018 and on 2018 the fair market value is 3 lakhs. So he's transferring in 2018 only. So it is a short-term capital asset for Vijay. And since it is a short-term capital asset for Vijay, indexation is not done. Less index cost of improvement for J is nil and less cost of improvement for Vijay is nil. So long-term capital gain for J becomes 1,93,333 and short-term capital gain for Vijay is 2,10,000. Less exemption, we know we'll get exemption under section 54B. Now, Exemption is given if you are having a agricultural land which you are using it for more than 2 years and then you are investing in another agricultural land. Now Vijay has acquired it in 2018 and he's selling it off on that date of transfer, which is 2018. Therefore, he is not using it for more than 2 years. Therefore, Vijay will not be eligible for exemption under section 54B. Therefore, it is nil for Vijay, and for Jay, it will be applicable. What is the amount of exemption given under section 54B? The amount of exemption given under section 54B is the long-term capital gain, okay, which he is getting, that is 1,93,333 is the exemption amount that he'll get. Therefore, the taxable long-term capital gain in case of J is nil, and taxable short-term capital gain in case of Vijay is 2,10,000. Since Vijay does not use the land for 2 years, hence he is not eligible for deduction under section 54B. So students, have you all understood this? These different sections you all can apply only if you all know the conditions which I have given in your theory notes as well as I've explained in the presentation. So have you all understood this section 54B? Yes, students? Have you understood this, some students?
Yes, ma'am.
Okay. So remember the important sections that we are going to that is frequently asked in the exam is section 54, 54D, 54F is maximally asked in the exam, but that doesn't mean that you'll ignore the other sections. Quickly, section 54, residential house invested in residential house. 54B, urban agricultural land invested in an agricultural land. 54D, land which is used for industrial undertaking invested in a land that is used again for an industrial purpose. EC, that is any long-term capital gain that is invested in the bonds, that is specified bonds by NHEC or Rural Electrification Corporation. Then 54EE, that is any long-term capital asset invested in specified bonds. 54F, any long-term capital asset other than residential house invested in residential house. But the other conditions also you need to look into to apply the exemption limit. To be revoked, that also has to be checked in. Next, income from other sources. We have only the theory part. So what is income from other sources, students? If an income cannot be taxed in any of the 4 heads of income, it is to be taxed under the head income from other sources. We know that if a particular income is not falling under the income from the head salaries, house properties, or business or profession, capital gain, that income will be taxed under the head income from other sources. So under this particular head, what we will be covering now is few list of incomes that are taxed under income from other sources. We will be seeing which are the different types of incomes, a few list of that which will be taxed under the head income from other sources. We will be seeing that under this section, what are the deductions allowable, what are the deductions you will not be getting, and what are the tax rates on income from other sources. So we will be covering this 4 aspects. So few list of income that are taxed under income from other sources is dividend income. Now dividend income does not fall under any 4 heads of the income. Therefore, it will be taxed under the head income from other sources. Gradual income. When I say gradual income means it is winnings from lotteries, crosswords, puzzles, races, including horse races, card games, other games, gambling, betting, etc. So when these words are used, it is called as gradual income and it is taxed under the head income from other sources. Next, consideration received in excess of fair market value of shares of a closely held company where such shares are issued at premium. If you're receiving any consideration in excess of the fair market value, it will be taxable under the head income from other sources. And we have already seen that interest on compulsory compulsory acquisition by the government in capital gains, we have seen that interest on enhanced compensation or initial compensation, that interest is taxable under the head income from other sources. So these are the few list of incomes which are taxable under the head income from other sources. There are many other falling in the list which I have covered in the notes. Next part, we have to see what are the deductions available under this section. So deductions available under section 57, that is from income from other sources. What are the deductions? Now, if it is a dividend, in case of dividends or interest on securities, any reasonable sum if you're paying by the way of commission or remuneration to a banker or any other person. Suppose you're receiving dividends. To receive that dividend, you're making an expenditure of paying the commission to a banker. So that commission to a banker that you're paying to receive the dividend, it will be allowable as a deduction. You can deduct it from your income. Next, income consists of recovery from employees as contribution to any PF superannuation fund. So amount of contribution remitted before the due date under the respective acts in accordance with the provision of section 61A subclause 5A. So what does this mean? That if the employees have failed to give any amount as contribution to any PF and you're recovering that amount, so whatever contribution amount is being remitted, that will be allowed as a deduction. Then if you're getting any income by the way of letting on hire of plant, machinery, furniture with or without building, then whatever current repairs you're doing to the plant, furniture or building, it will be allowed as a deduction. Insurance premium that you're paying on the plant, furniture, building, it will be allowed as a deduction. Depreciation will be allowed as a deduction. So suppose if you're earning income by renting out your land, renting out your furniture, plant, machinery. So whatever expenditures you're doing on that machinery, plant or furniture, like repairs, insurance, depreciation, it is allowed as a deduction. Family pension, if you're receiving, it will be taxed under the head income from other sources. But what is the deduction you can get for family pension is sum equal to 33 1/3% of such income or 15,000, whichever is less. So suppose your family pension is suppose 50,000. So 33 1/3% of 50,000 or 15,000, whichever is less, you will get as a deduction. Interest on compensation or enhanced compensation, 50% of such interest will be allowed as a deduction and only on the remaining you need to pay tax. Sixth one is a general one. Any other expenditure not in the nature of capital expenditure incurred wholly and exclusively for earning such income. So any other expenditure which you are going to make to earn that income, okay, but it should not be in the nature of capital expenditure. So such expenditure you are allowed as a deduction under section 57. So remember, under section 57 you will get deduction of any expenditure that you're making, revenue expenditure, which is a expenditure incurred to earn that income. Next, deductions which are not allowable means you will not get a deduction for the following. Any personal expense of the SSC, you will not get a deduction. Any interest chargeable to tax under the Act which is payable outside India, on which tax is not been paid or deducted at source, you will not get a deduction. Any payment chargeable to tax under the head salary, if it is paid outside India and tax is not deducted, you will not get a deduction. 30% of sum payable to a resident on which tax is deductible at source, but if such tax has not been deducted or after deduction has not been paid before the due date, no deduction will be allowed. Any expenditure in respect of which a payment is made to a related person to the extent the same is considered excessive or unreasonable by the assessing officer having regard to the fair market value, means suppose to a related person you're making an expenditure which is actually not as per the market value and it is extra or excessive as per the assessing officer, such deduction will not be allowable. Any expenditure in respect of which a payment or aggregate payment exceeding 10 lakhs is made to a person in a day otherwise than by account pay check or ECS through a bank account, then such deductions will not be allowable. Now, Let us see tax rate on income from other sources. Now, if it is a gradual income, I told you what is gradual income. Gradual income means winnings from lotteries, crosswords, puzzles, card games, gambling, betting. If you are earning any gradual income, 30% of such winnings will be chargeable to tax. Suppose if some student of ours participates in Kaun Banega Crorepati and they win an amount of suppose 50 lakhs, then entire 50 lakhs will not be given. From 50 lakhs, 30% tax will be deducted and the balance amount will be given. So remember, for gradual income, 30% of such winnings, or suppose you are winning a lottery of 20 lakhs. So 30% of 20 lakhs will be deducted first as tax and the balance will be given to you. So gradual income, 30% is the tax rate. Dividend, if it is a dividend, 10% of that dividend only if it is in excess of 10 lakhs. So if you are receiving a dividend of more than 10 lakhs, 10% of that dividend will be chargeable to tax. Balance dividend you will get. Next, unexplained cash investments or expenditures. Suppose if you have some cash in your account or you have jewelry for which you have no expenditures, the assessing officer will ask you from where have you got this, and you have no proper accounts to show that from where have you got or what is the source of this particular income. It is a black money and you have no proper explanation for that. So the tax rate for unexplained investments is 60% of such income plus surcharge 25%. So the effective rate is 78%. And apart from these three, if there is any other income which is falling under the head income from other sources, it will be taxed at the normal rates of tax. Normal rate of tax is a tax slab rates, individual tax slab rates, which we have seen in the module number 1, that whatever normal tax rates of slabs are applicable, that the other income will be taxed to that particular tax rates. So these are the tax rates falling under income from other sources. Casual income 30%, dividend in excess of 10 lakhs 10%, unexplained cash credit 60%, and for other income the normal tax rates will be applicable. So by this we have completed the theory part on income from other sources, where we have seen the meaning, a few lists falling under income from other sources, allowable deduction under income from other sources, disallowed expenditures under income from other sources, and what are the tax rates from income from other sources. So thank you so much, students.